And almost every fund we've done, we've had a hot company in the first year that looks like it's going to be a breakout winner that gets off to an incredibly fast start. With the benefit of hindsight, in no case in our fund has that company ever turned out to be one of the companies that matters. And in 2 of the 4 cases, those companies went to zero.
Today, I am very happy to be joined by Charles Hudson. Charles is a bit of a legend. He's the founder and managing partner of Precursor Ventures, which is an early stage VC firm that is focused on investing in the first institutional round of investment for the most promising software and hardware companies. Very brave. He invests in people over product at the earliest stage of their journey, and under his leadership, Precursor has raised 4 funds, now has over $175 million under management. He's invested in more than 375 companies, including Clearco, Juniper Square, The Athletic, which was acquired a few years ago by the New York Times for over $500 million. And this is how we actually first met. He was also the co-founder and CEO of Bionic Panda Games, which is he's yet another great example of my thesis that all the most talented people in technology worked in gaming at some point, which was an Android-focused mobile game startup based in San Francisco. He's also a very active member of the VC community. He was the 2023-2024 chair of the NVCA Board of Directors, was a board member of Venture Forward. He's on the investment committee of Screen Door. And we're going to be here all day if I keep going through Charles's many accomplishments. Suffice to say that he's an incredibly accomplished investor and a very generous person with his time and mentorship. So I'm really happy to have you here. This has been a long time in the making.
I'm really psyched to be here.
All right, so let's get straight into it. So you said recently that you think that the era of seed that we were in for the first 20 to 25 years of seed investing is basically over. So I'd love for you to just expand on that a little bit. Tell us more. Tell us why.
Yeah, I started having this conversation with a handful of my friends in seed investing about a year ago. I was like, guys, seed is coming up on about 20 years old. If you go back to the micro VCs, the super angels, that whole era in the mid-aughts, that was kind of the beginning of institutional seed in my mind. And if you think about why seed was created, there was this gap. There were Series A firms that ironically back then did kind of what seed firms do today, which is like find people who have a little bit of a something and provide them with capital. There was this feeling that there were companies that were too early for the big multi-stage firms, and maybe we need this brand new layer of firms that have more punching power than angels, but are not as institutional as the Series A firms, to help shepherd people at the idea stage to get them ready for more capital. And I'd say for 20 some odd years, with fits and starts, the seed ecosystem grew to be in some ways kind of like a finishing school, where you would take people who had raw ideas or maybe a prototype and needed money and time and space and some mentorship and advice to get to a place where they'd proven that the thing they wanted to build was worthy of more capital. And it was pretty symbiotic. The seed funds did most of that 0 to 1 investing and helping companies. When those companies were ready for presentation, the seed funds who had great relationships with the multi-stage funds would introduce those companies, and the Series A folks would pick the best ones from that lot. Maybe if you were doing your job right, we'll put the ZERP era aside. Maybe somewhere between a third and half of the companies that you worked with from 0 to 1 made it to Series A. Then you as a seed investor would sort of say, hey, congratulations, you've made it to the next level. I'm going to hand this relationship off to this great Series A investor. They're going to take you from here, possibly all the way to IPO. And it was very symbiotic. And I think part of the reason why it works so well is that the multi-stage firms didn't really have that much interest in doing that 0 to 1 work with founders who were not already in their network. And so they essentially seeded that market, no pun intended, to seed investors and said, this is your thing. You guys do this, we will harvest. And I think partially because seed investing turned out to be a pretty big business. And it was a pretty good business to find these companies at low valuations and work with them. And because the big multi-stage funds have gotten significantly bigger, I think at some point it seemed like, well, maybe we shouldn't just seed the seed market to specialist funds. Maybe we should have position in this market too. We can raise a couple $100 million per fund cycle to deploy against seed. We have a good brand. And so I think that sort of this swim lane that was seed only that the multi-stage firms were interested in, I don't think their attitude or stance is the same. I think they want to be in that business too. Not necessarily to drive seed firms out of business. I don't think that's the intent. It's more like we want to have our own play in this space alongside what dedicated seed firms are doing. And that's a change. And to be clear, there have been other eras and moments where big multi-stage firms have dabbled in seed. And I think in most cases, they've pulled back either because there were more interesting things to do. The sort of opportunity cost of deploying those dollars to seed versus the core strategy felt high, or there was some signaling risk or brand risk from doing a lot of seed deals and not following on in the A. And I think almost all of those conditions are no longer true. I talked to a ton of founders who are like, look, if I take a Series A, if I take a seed round from a multi-stage firm and they don't do my A, it's probably because I didn't build a great company. Signaling risk is not something I'm going to worry about. I think the ability to raise large pools of capital has meant that for those multi-stage funds, there's no opportunity cost for seed. It's its own pool of capital. They can raise enough money for every other strategy. So it's not as zero sum for them. And I think they've seen the returns to be had by getting into these relationships early, and the ability to buy and own more of great companies earlier is something that's important for their model. So my assumption now is they're going to be in seed forever, unless for some strategic reason they decide it just isn't a great place to be. It won't be because they don't have the capital to do it, and it won't be because they're worried about brand risk.
Do you think their reasons for being in seed are, I think you've talked a bit in the past about the different business models that firms like yours have, and the multi-stage firms. Do you think that their motivations are primarily pipeline driven or returns driven, or do you think it's really just actually both?
I think the hardest thing in venture sometimes is to try to be objective and optimistic about something that people are doing that's maybe not good for you. I think the cynical thing that a lot of seed managers said was, oh, hey, Mr. or Miss Founder, like, take their money. They don't care about their seed program. This money doesn't matter to them. I don't think that was ever true. I think they've always cared. I think maybe it's been less important than the main event, which is usually Series A and B. That's the main event. They really care about that. So my sense is if I were running a big multi-stage venture fund, my biggest fear would be losing out on access to an amazing founder at the earliest stage. And if you were saying like, well, look, we're just going to wait till this really famous repeat founder does their Series A and we're going to try to get into the deal then. If I were running with those firms, I'd be like, why? Why can't we get into this person's company as early as possible? And if you think about the situation, if you've got a $500 million seed fund or a multi-$100 million seed fund, you should be trying to get into these great companies. And if a repeat or high signal founder, someone you think has an amazing reputation or background that's going to make them uniquely successful, says, hey, I want to raise a seed round of $4 million, but I want to do it on a 40 post. And you're like, well, I'm doing this to get access to this company so that I can invest 20 million in the A and 30 million in the B. Let's do 4 on 40. That's fine. If that's what makes you happy, it's not that this seed check doesn't matter. It's that this seed check buys me access to the ability to invest significantly more capital in the future when this thing works.
How true do you think the argument is, which is the argument made by a lot of seed managers, is, hey, this check they're writing you is kind of insignificant. You're not going to get the level. Whereas if we write you a check, this is a much more meaningful chunk of our AUM. You're going to get a lot more bandwidth and attention from us. I would say, how convinced are you by that argument? And how, and more importantly, how much do you think founders are also? How much does that resonate with founders?
I think signaling risk and attention. So when I was at Uncork from like 2010 to 2015, that argument really carried the day. A lot of founders were like, so I'm going to get the worst of all worlds if this is like a mediocre outcome. I'm going to get their money, but I'm not going to get the time from the partner that I wanted. And when it comes time to raise the next round, they're not going to do it. And when anyone calls them and says, what do you think about this company? The partner's going to be like, I spent no time with that founder. It was the potential for a scarlet letter. I think something we don't talk about enough in venture is like founder money market fit. And I've met a bunch of repeat founders who are like, I'm not actually looking for that much help. I'm actually looking to kind of be left alone unless I need help. And then I'll reach out to you. Telling somebody that like the people are going to give you money at a high valuation and not much support or help, they're like, cool, that's actually what I'm looking for. You've like properly described the product I'm looking for. I'm actually not looking for a help and insights product. And I'm not saying every repeat founder works this way, but I've met a bunch where just like, I kind of know what I want to do. I know how to recruit. I've done this before. When and if I need your help, I want to know that when I text you, you'll call me back. Or if I email you, you'll be responsive, but I don't need to talk to you once a month. I'm not looking for advice or tips. I'm actually looking for like capital and like space. And ironically, the things that were bugs before are features for these folks. So
the way you're talking, I think there's a particular founder archetype that comes to mind here, which is the obvious founder for these multi-stage firms. So highly credentialed, repeat founder who had a meaningful outcome before, coming from a now very hot kind of company like a OpenAI, Anthropic, or something like that, and pursuing something that is very ambitious and potentially also very capital intensive. And I think you've argued elsewhere that the multi-stage firms are overwhelmingly likely to win those founders. They're not going to be sort of hard to find, and they're going to approach them probably. And they don't, as you say, they don't need to be handheld. At the same time, and again, I'm sort of generalizing here, and so you tell me if reality check me if I'm wrong here, but it feels to me like many of the largest outcomes in venture weren't always the obvious founders in hindsight. And so the multi-stage firms, as well-resourced as they are, they probably can't cover every geo, every sector, with the best will in the world. Like the limiting factor for them is still it's still quality of people fundamentally. I mean, it's the limiting factor on all of us. So does that sort of carve out a more hopeful space? Like, is that really where our business should be, is finding the non-obvious people and concentrating on them?
I believe that's where the alpha is in seed. And I think what feels different is there was a period of time where I think a lot of highly credentialed repeat founder, people who were early at highly consequential or well-known companies would seek out seed firms for that first round of capital. And I think that in some ways, I don't want to say it was an arb, but it did feel like there was this tier of founder who could have gone to the multi-stage firms who were choosing seed firms. And those were like great companies to back if you were a seed manager, because you got access to these like really talented people. But David, I think what you said is, for me, the big question, which is what percentage of the future alpha and seed is going to come from these repeat, highly credentialed people? If you believe we'll take an extreme case. If you think 75% of the alpha comes from that community of people, that only leaves a pretty small pool for the dedicated seed people to fight over. And if you're an LP, you might be like, well, if I can get 75% of the alpha and seed by doing big funds, maybe I just do big funds and call it a day and say the other 25%, it's not worth chasing it. I don't believe it's that high. And if you believe it's zero, to go to the other extreme, then you're like, all the big multi-stage funds are doing is wasting their money funding people that are easy to fund but unlikely to produce exceptional companies. I think it's probably not zero either.
Right.
And so the hopeful case for me is there is some meaningful chunk of companies that will come from this pool. Maybe it's 25% that will be, repeat founders or employee number 1 at OpenAI or employee number 2 at Anthropic or employee number 5 at Stripe, whatever it might be. They will go on and create these like truly iconic companies. And remember, the big multi-stage funds need $5 to $10 billion outcomes. That's like the minimum outcome scale they need to move the needle, given the size of their. And I say minimum 5 to 10, like they're not putting a statue in the lobby for you for one of those. That probably starts at 2025. It's just the nature of the math in the business today. So my belief is there's a pretty big chunk of the alpha and seed that's going to come from first time or not yet consensus brilliant founders. And that is the opportunity for seed managers, is to find and identify those people. And I think that's an evergreen pool of people. So there will always be room. The question is like, will it support the scale of seed investing activity that's happened in the last 10 or 15 years? I don't know. And I think the other thing is, seed managers compete for capital with big multi-stage funds. And as much as it's important what I think, it's also important what LPs think. And so if LPs become of the mind that like, these big multi-stage funds have told me a really great story about their ability to capture the people that we think are most likely to capture and create great companies, then to some extent, like, I wouldn't say it becomes a self-fulfilling prophecy, but it means more of the dollars that are deployed at seed will be controlled by multi-stage funds, which means you will get more seed stage companies that fit the preferences and belief system of those funds. And so the really crappy thing is 10-year fund lives are a feature and a bug in venture. We won't know. This shift is happening now. I think it's like hard to argue that it isn't. But we're in the kind of early eras. And like, I'll tell you one thing that got my attention. When Wiz almost got acquired by Google, that got my attention because I was like, that was a very expensive seed round at a price that wouldn't make sense for most seed funds, but had an outcome that would have been material for a fund like Sequoia. I was like, oh, well, if the future of seed is 150 post entry at $23 billion exit, most seed funds aren't set up to play that game. Like we're just not. But I remain very optimistic. And also I'm seeing plenty of evidence that there are really talented people who are not the obvious ones on the radar of multi-stage firms. And I think those people will continue to create great generational companies. It's just a question of like, where does that balance land between those two communities?
You said a lot of really interesting things there, and that sparks a number of conversations. I'll try and follow each thread in turn. And like the one first, the one I want to start with actually is the LP question, because one thing I've learned from in my 2 years of being in venture now is LPs are not a kind of one big blob. They subdivide into all sorts of different types of LP, and they have very different check sizes that they write and reasons for investing and return expectations and all the rest of it. What conclusions, if we would sort of talk about this hypothetical where, for a lot of folks, the multi-stage firms are getting enough of the seed alpha that they don't really need to go further afield. What types of LPs do you think that's more likely to be true for, and what LPs are potentially likely to still gravitate towards smaller funds who can be finding things that are a little bit off the beaten track, investing at lower valuations, and because by nature of their fund size, still have very respectable, MOIC at the end of it, and eventually DPI, of course, which the
yes, our friend DPI. I will say this. I'll just give you like 2 archetypal LP meetings I've had in the last month. One, I met a person who worked for an institution. He was their early stage venture person. That was his whole job, was to like understand early stage venture. He was part of their venture team, and they had 3 people on venture, one person who did early stage, one person who did kind of like Series A, and one person who did growth. And that team was part of a broader private equity team, which was part of an alts team. Talking to that person was a joy. He had a really like nuanced, pretty comprehensive view of how seed investing works, and was able to like follow some pretty like, I'd say like nuanced like differences about fund size and strategy. I also met with someone else who was responsible for all privates at their firm. And he was a one-person who did real assets, private credit, venture capital, and PE. I felt so bad for this guy, David. I was like, well, that's a lot on your plate. But he was like, I'm responsible for privates. If I were that second person, I'd be like, well, we're going to allocate to venture. how do I do this in a way that's efficient given all the things I have on my plate? And I'm not going to lie, someone coming to you and saying, listen, we are a big brand name firm. If you give us some arbitrary amount of money, we will allocate that money across all of the strategies in venture that matter. And with one conversation and one relationship, you have solved your venture exposure problem. And you've done it with a highly regarded, well-branded firm.
Which no one's going to fire you for. Which no one's going to fire you for writing.
No one's going to fire you for that. And those firms have earned their reputations. And so I think it's totally rational. Or here's another one. You're a big pension fund and you're trying to move money in $50 or $100 million blocks at a time. Are you really going to go? You could argue that the returns optimizing thing would be to go meet a bunch of managers and find 10 people to take $5 million from you each. That's probably a couple hundred meetings for you. Or you could take the 50 million and give it to one person and say, I trust that you will allocate this money across multiple strategies in a very effective way because you're a highly regarded firm. And so I think sometimes it's important to remember that the allocation decisions that allocators are trying to make are a function of the amount of money they're trying to put to work and the importance of venture in their broader portfolio. And for some people, they're like, I have a lot of money to put to work in venture, but I don't have a lot of time because while it's a lot of money in the grand scheme of things, it's not that big of our overall portfolio relative to publics or real estate or whatever other asset classes we're in. And so I think different funds solve different problems for different LP types. And I found as a manager who runs a sub-$100 million fund that's focused on a really specific type of founder at pre-seed and seed, whenever I meet somebody who has a dedicated early stage person on their team, the conversation is richer and the probability that we're going to get money is much higher. Whenever I meet somebody where I'm like, this person is like overstretched and venture is one of 10 things they're responsible for, it's harder to make the nuanced argument about why a small fund like mine needs to exist and is doing interesting work in the ecosystem.
Do you think that I'm sort of seeing, it feels like a lot of new fund of funds are being spun up around the place. And the argument most of them seem to be making is actually the big multi-stage firms, for all the reasons we've discussed, may actually, we'll get to it, but they're deploying untold amounts of money into foundation model companies. And it's still an open question as to, what the returns will be like, when you're investing in a multi-billion dollar valuation and putting a lot of capital work. And so the argument a lot of them are making is actually there is still alpha in seed funds. Mm-hmm. It's impractical to go and evaluate hundreds of managers and, hey, that's what we're going to do. Do you think they're going to play an increasing role in the ecosystem sort of in this next era?
I do. The question is like, what are they going to fund? What are their preferences going to be? And I think it's interesting. I tell people all the time, the friends of mine who are spinning out of established venture platforms with the blessing of their old firm have a really different fundraising journey than people who are starting from scratch. I don't know when to tell you this, but
I have a friend who just went through that, and I'm just standing by in awe and incredible envy at his fundraising experience to raise his $50 million fund.
And I'm sure he thinks it's the hardest thing he's ever done. And I'm sure from his point of view, it was hard.
I don't know. I think he knows he had a pretty great experience.
Yeah. And so I think sometimes in venture, there are things that are easy to buy and things that are hard to buy. I think buying spin out GPs from well-known platforms, particularly if you as a fund of funds already have a relationship with that platform and can get some insight from the leadership there about why that person's leaving and how highly regarded they were and how supportive they are, it's pretty straightforward underwriting. Versus then you've got someone who's got an angel track record but never been institutional. Then you have the person who's like has limited experience in venture but has a really strong thesis. Like, it takes a certain amount of courage to do that last bucket. But I also think that's where some of the best funds and best managers I've met came from. They didn't have an extensive free education in venture, but they had an insight on people or an insight on a market that like served them well. So for me, the question is like, what are these new fund to funds looking for? What do they think good or great looks like? And if it's just spin out managers from established platforms, I don't think it really changes the ecosystem much. If those funds, like, I give the team at Sendana a lot of credit. When Michael started, the idea that we would have a bunch of really successful sub $100 million seed funds and that would become an asset class was not a widely celebrated idea. Most people were like, can you even make money with those things? Like, they're so small and like, doesn't matter. It turns out like, yeah, you can. And I think that was and he bet on some solo GPs, he bet on some new people. So I think when fund to funds do their job right, and look, this is something we talk about a lot at Screen Door, you're bringing new people into the investing ecosystem. You're not just helping people who would probably otherwise be successful faster.
Okay, I think it's time to move on from LP, GP shop talk, and let's talk about the people who actually matter a little bit more, which is the founders and the companies they're building. And so you've described the job of seed funds, and we've talked a bit about this already, as finding those, and we've discussed that the obvious founders are going to gravitate towards the multi-stage fund. Our job is to find the non-obvious deals, the non-obvious founders, that will be consensus good and therefore fundable and successful in the future. And so I want to dig into your experience on finding those folks. And so I think that maybe the first question is, when you look back on investments that fit that profile, what commonalities do you observe either about the companies or the founders or both?
Some of these things, I know I'm not the first person to say these things, so I say that with full obviousness. One of the things, so it's funny, we've made over 400 investments now at this point, and I've gone back and at various times looked at what seems to correlate with success. A couple of things stood out immediately. One thing, it sounds so obvious, and I don't know why I didn't see it sooner. Previous startup success is not that important. Previous startup experience is wildly important when you're doing 0 to 1. And I'm convinced it's because no one tells you what to do in 0 to 1. You have to know. And you have to know what to do, and you have to have some innate sense of pace and timing and how quickly you're supposed to be moving, because every day the clock is working against you. And we've funded some teams from Meta and Alphabet and big companies who were incredibly successful in those environments. And when they've left and gone to 0 to 1, they've been really unsuccessful. And I've talked to a bunch of them, and one of them told me one time, he goes, wow, everything that helped me get promoted at Meta has no value in my 0 to 1 startup. I'm like, yes, you are correct.
Getting buy-in from key stakeholders.
That's right. Managing up all of these things. And so part of this is like, previous startup experience is something I put a lot of weight on, and I really don't care that much about how successful or unsuccessful the company was. More that like, did you really experience that early stage kind of sub 25 employee time? And are you choosing to go back into that chaotic environment? Only about Have you
also seen successful or unsuccessful? I've been involved in both. I will say that there is something quite powerful about seeing what real traction looks like. I think back, and we were both active in these we met actually in the early days of social gaming on Facebook. And I still have vivid memories of the day we built several games that didn't work. And then we built this early farming game called Island Paradise, which really worked. And, you could see it we started out here, hour 1, 100 users, day 2, 1,000 users. At the end of week 1, 20,000 users. And like, there was something incredibly intoxicating and powerful about seeing what real traction in the 0 to 1 looks like. Do you think that you need to have seen that, or do you think does it matter or not?
I think it's helpful, because I think it gives you a sense of like, what does it feel like when you really have pull? I don't think it's essential for a couple of reasons. One, we have found there are sometimes great people hiding at bad companies, particularly earlier in their career. They might have joined a startup, not really knowing what to look for, but just wanting to be in a startup.
Yeah.
oftentimes the people we're funding were not in charge of the startup. So if the startup was not successful, it's usually not due to something they did or did not do. And also, we've had success with people who worked at companies who didn't work, who are like, oh, I was inside the machine. There were a couple decisions. If we made different decisions, this might have worked. Or by being here, I saw this other opportunity that I couldn't convince people to pursue, but it was obvious to me. So a lot of the people we back, I should just tell you the profile, about 2/3 of them are first-time founders. Most of them have, like, call it a decade of work experience. So they're not like fresh college grads, but most of them have never been in the C-suite. So think like your strong individual contributor to maybe frontline first-time manager. And I learned one really important thing from doing references on these people is oftentimes even their managers are poor at estimating how successful these people will be as entrepreneurs. And the one big unlock for me is one day I was like, oh, I understand why this is hard. I'm basically judging people on their prospective ability to do a job they've never done before. I'm taking somebody who was a product manager and saying, I'm not interviewing you to be the head of product. I'm interviewing you to be CEO. And by the way, being CEO is going to require you to be good at like 8 to 10 things you've never done before. Like most individual contributors have never really fired anybody. And to the extent you have, it's been using a process and guidelines that your HR department or your company outlined. And I'm like, oh, you're going to run a startup, you are going to hire somebody and you're going to sit across the table from that person at some point. You're going to tell them it's their last day. And you have to do that. I can't do that for you. And you have to have the fortitude to do that.
Also, I think even potentially more relevantly, you have to reach the decision to do that within a specific time frame. And I think if there's like one thing I've found myself repeatedly coaching some founders that we've worked with on, this is probably not a good thing to say publicly on a podcast or what have you, but usually in startups, the first moment you think, people always fire too late unless they have the kind of experience. And usually the first time you think this person's probably not going to work out, I know because I've been through the whole sort of calisthenics of contorting myself into, well, if we do this and we do that, and 6 months later you end up letting them go anyway. It was the best thing for both the company and for the person as well. So we're getting to the next thing I wanted to dig into, which was how you evaluate founders. And actually, the thing that prompted me to reach out to have you on and talk about this in the first place was I kind of made a LinkedIn shit post that I threw together some, and then as always happens here, you throw something together in like 2 seconds, don't you think about it, and it goes viral. And so you reached out to me and you said, actually, we do have a framework. It doesn't look like this. And so we'll get to that. But maybe first, I want to ask you what experience has taught you about the balance between how much, when you're making an investment decision, are you investing in the founder versus, I really like this idea, this pitch, I think the market they're going after, I think the early version of this product I've seen.
Yeah.
How do you balance those two things?
It's super hard, and we have evolved as a firm. When I first started, we were like, because most of the companies we invest in, there's no product to assess. So we'll just assume product equals 0. In the beginning, I was like, it's 60% the person, 40% the idea. And what I realized very quickly was I said no to some amazing companies because I thought the people were great, but I had lukewarm views on the market, or I thought I knew more about the market than I did. And I said no to some really good companies because my subjective assessment of the market, I put too much weight on it. And so I started looking and saying, well, is 60-40 the right slider? And I'm like, well, let me tell you why it's not 100% founder, because most of the rounds we do are $1 million or less in size. If you have a terrible idea, $1 million is actually not enough time and space to pivot into something better. You'll probably run out of money before you get to the better idea. Versus if I do a seed round of $5 million, I'm less concerned about the idea because I'm like, this is a team that has enough money to find a good idea. So what I tell people is I need you to be in the neighborhood of a good idea.
Sure.
You have to be around something good. So now I tell people it's 70-30, 75-25 the people. And there have been some cases where I did the opposite. I'm like, I love this idea. This was such a good idea. And then I kind of overlooked some deficiencies in the founder, or I didn't overlook them, but I like bet on the person improving and they didn't improve. And I watched somebody else with a much better team just run away with that opportunity. And my conclusion was I should have like remained optimistic and excited about the opportunity and waited for a better team to come up.
So this naturally leads into the second part of my question, which is, a typical fundraise, and there are other ways to approach this, but if there's a team going out looking for funding and they're running a tight process, you have a handful of conversations with the founder to make a decision.
Yeah.
So, and I'm also very aware that there are people who pitch really well and all this stuff. So how do you actually assess in as objective a way as possible the quality of that founder? And maybe you could talk through this founder scoring system that you've put together.
About a year ago, I'd made a comment, I was like, I really like this founder. That's why we're investing. My team was like, what does that mean? I'm like, I like them. I think they're going to be successful. My team is like, but like, what's really going on in your head? And I was like, that's a fair question. I started having LPs asking me questions like, hey, like, what correlates well with success? So we did this big project, and that's how I got to this like previous startup experience, sometimes people working in their own domain. And I said, for the benefit of my team, but also for my own benefit, what if I just started writing out all of the things that are going on in my mind when I'm evaluating a founder and tried to make them more explicit? And if I think about like, what does it take for a new founder to be successful? There's a couple, and I'll be the first to admit some of these things are like totally subjective. But oftentimes I'm looking at problem-solving ability, which is usually a proxy for the connection between the product vision that they've told me about and the underlying problem that they're trying to solve, and like the depth and thoughtfulness around the solution. Do I think this person can lead? Do I think they can like build a team around themselves? And usually I look and see like, well, what have they already assembled? Like, what evidence is there this person can lead? And separate from lead, can they recruit, which is like a subset of leadership? I try to score them on, based on my experience as someone who hears a lot of pitches, how good is this person at fundraising? At the end of the day, how clear is like what needs to be true for this product to work? Those are all graded on a 1 to 5 scale, and it spits out a number. That number doesn't tell me whether or not I should invest. It tells me where in the distribution of people that I've met and scored in the past does this person land. And then there's a bunch of other kind of binary questions I ask, like in spending time with this person, what do I think they're uniquely gifted at? Is it storytelling? Is it product? Is it technology? Is it sales? Did I meet the whole team? Did I meet all the founders? Is this person in my network? Did I meet them in person? Which turns out to not really matter very much based on our returns if I met them in person before we invest. And then I ask, it's funny, I don't even know if all the founders that we have invested in know that I ask all these questions and fill this out, but they'll know now. I ask one really important, for me, that's an important question, which is 24 months from now, do I think this person will still be at the company in the same role? And sometimes the answer is no, and that's okay. So in addition to that, I have people do a self-assessment form, which asks them a bunch of questions, and it gives me, because remember, most people I invest in, I don't know them. So I'm trying to gather as much information as I can about them. But it's been interesting because sometimes I've met a founder and I've gone through this exercise and I've looked at where they landed in the distribution. I'm like, wow, either this person's not as great as I thought they were before I went through the exercise of actually writing down what I think, or I just see a tremendous amount of potential in this person, and I'm betting that they're going to close a lot of gaps over the course of this fundraise.
If I was going to give you a hypothetical of a founder that's scored quite well across the board on your sort of the set of things you're evaluating on, versus someone who's much spikier, like super high in one or two areas, kind of low in other areas, which would you, if I force you to pick between them, which would you pick?
Spiky. Also, like, the thing I've come to realize is being bad at fundraising, as long as you're not criminally bad at it,
it can be coached.
It can be coached. We can help you with that. Problem solving, like the things that seem to be harder to teach people are like how to diagnose and solve problems quickly, how to move with urgency, and how to like marshal resources around your company that are probably like, how do you get smart people to join your company when like it's kind of irrational to do so?
Yeah.
Those are things I don't know how to coach or teach. People either show up
No.
with some ability to do those things or they don't. And the urgency, David, is the biggest frustration I have. If I could coach or teach urgency, and that's the thing I'd probably screen for the hardest, is if I'm like, this person just doesn't seem to have a real, and sometimes it comes up, like I'll ask people like, well, where do you think the company will be in a year? And they'll tell me, and I'm like, I think I'd be disappointed if that's all you're
Yeah.
telling me that's like, whatever you tell me is already optimistic. So if that's where you think we'll be,
Right.
we will probably,
That's likely the absolute ceiling, because they're likely to fall short of it.
yeah. So so there are certain things in this system that matter more than others. But part of the reason I started doing this is like, I want to be able to look back. We do this at the company level. We do a similar analysis of the company. I want to be able to look back on the people I picked in 2 years from now and say, the top 5% of the companies in our portfolio that are driving returns, like what did they look like at day? What did I think I had in my hands with these people? And my hunch is they're going to be in the middle of the distribution. The one thing I have found is if you're on the like left far tail and you score super low, that's actually a few times caused me to go back and ask myself, are you sure you want to give this person money? And in a few cases, I've been like, wow, this is really what I think of this person. This is a lot of growth that has to happen. And do I really think that's a likely outcome?
Tell me a little bit more about the self-assessment. What did you come up with that? Is that some sort of existing framework, or what does that look like?
We hacked a recruiting tool that's like an HR part of a recruiting tool that's kind of like something you would use to score candidates applying for a job. We hacked it to use it as a self-assessment tool for founders. And a lot of it is like, how do you respond to stress? It's got like some classic DISC. It's got some of the classic, like a lot of it is like personality stuff. Like, who are you as a person?
Big four sort of stuff.
It's got big four, DISC, all that kind of stuff. And it gives me some sense of like who the person is that I'm about to get into a relationship with. And like, what are their strengths? How do they think about things? How do they respond to stress? What do they look like at their best? What do they look like at their worst? It also includes some friendly references. I'm like, you pick the people who give us. I want them to be people who know you well enough. And I tell people like, this isn't a gotcha. This is a way for me to get to know more about you in a pretty compressed time frame. And it's been really helpful to have those self-assessments because it gives me some sense of like a basic personality type that this person has. And like, what am I likely going to get when I work?
Do you back channel references at all?
We do. I just think you have to be really careful. What I have found is people who reported directly to a founders oftentimes do have a good sense then, will this person be successful as a founder? I find that a lot of people I meet, they reported to somebody who's never been an entrepreneur.
Right.
And sometimes you're like, oh, this person was very hard to manage. Like, you know, they were
no
didn't
shit,
really take direction. Like, sounds good. But what I will do is there are some things to me that are reasons I will do more work. If it's a founder who's raised money before and I don't see any of the previous investors on the cap table, I will always want to find out why. And it doesn't mean that I won't invest, but I really want to know why. Sometimes I'll find people who've worked at a company where I know a lot about that org, and I'll want to talk to people who were in that org at that company to get a sense for that person's reputation. But I just, in most cases, I'm trying to make sure that the person is who they said they were and that they did the things that they said they did at the company and that the reasons for their departure largely met. And in most cases, like, it's fine. Like, a lot of times I'll beat people. I'm like, this doesn't require a lot of interest. And we also do criminal background check, which also includes like employment verification. So some of the stuff we just do using software, but like, especially if a person was at a company that I know well, I will usually just want to know more. Well, what do people who I know, who also know what I'm looking for, think of this person?
So that's really interesting and really helpful. One of the things that is interesting about your fund specifically is you're a little bit unusual in that you are a solo GP. you're also, I think, 13 people. Is that right?
That's right. Yeah.
So talk to me a little bit about how that works and why things are set up that way.
Oh man, if portfolio construction is the number one thing that people get stuck on with our fund, the very unique way in which our team is architected is the number two thing. So the way we're architected is we have 4 people on the investment team. I have 1 person in investor relations. I have 3 people in finance, mostly because we do 40 new investments a year. Plus we have kind of an equivalent number of follow-on transactions, plus probably 20 or 30 M&A or dissolutions. It's just a lot of paperwork to track down every year. And I have a 5-person team that works exclusively for me on my personal productivity and supports me.
Wow.
So
5 people.
It's 40% of the firm.
Amazing.
Mm-hmm.
So this answers one of my other questions I have for you, which is how the hell are you so productive? I think we've just uncovered a little secret.
I have a chief of staff. I have a junior chief of staff. I have 2 people in the Philippines. And then I have an EA who has been with me for a long time, who only does scheduling, because that is a full-time. That's actually probably 1.5 time job. And we work together as a team on everything from my inbox to speaking engagements to projects I have. It's all hands on deck and I would not be able to operate at the level that I operate on without that team. And I have a coach who helps me figure out how to get the most out of that team and also hopefully make their jobs fun.
It just it makes me even more grateful for the time that you're getting. I mean, I assume that I'm talking to you and not some incredibly sophisticated AI avatar.
Well, it's funny. One of my friends was like, well, what are the benefits of having this team of 5 people? I'm like, well, I can be here and be present with you and not be worried about emails that are coming into my inbox or Discord messages and things like that. I can just say, there's a group of people who are watching that stuff for me while I'm here with you. And when we're done, I'll go back and they'll tell me, here's what you missed while you were away. These are the things that are most important. These are some things we tried to handle on your behalf. And these are things where we need your input. And that's how we work together as a team. And it's been really effective for me because it's the only way as a single GP I have any chance. If I were doing all of my own email and all of my own calendar, and look, no one can send an email as me but me. But sometimes the team helps me. They're like, this person asked for 10 things. We gathered those 10 things for you and put them in a folder. They're right here. When you're ready to send this email, you tell us, we'll attach those 10 things to it for you and we'll tell you it's ready to go and you can read it again. And so I need that team. And that team started off with 1 person and it's scaled to 5 as the portfolio has gotten bigger and my life has gotten more.
Really interesting. So that's the personal productivity piece of the firm. Talk to me a little bit about the investment team and how you set up, how decision-making works and how that's structured.
We do something that's a little different than most people. I went to my LPs a while ago and said, I want to find out if the investment people on our team are good and aligned with the kind of team I want to build. They said, that's great. So what are you going to do? I go, I'm just going to start giving them small amounts of money with full discretion. And they said, you're going to do what? I said, well, guys, we have 2 options. One is I could give them a small amount of money early and find out what their natural instincts are, what they think good looks like, what they can win their way into. Or I could make them sit on the bench for a couple of years and then I'd have to give them a lot of your money. I would rather give people a little bit of money after they've been at the firm for a year or 2. And I tell them all the same thing. Having managed associates and principals in the past and been around them at other firms, everyone I've ever met has always been like, there was a deal I wanted to do that I brought in and the partner hated it and it died and we should have done it. It was called Uber. Or there's always, or like, there's something I wanted to bring in, but I know that the partners hate this category, so I didn't even bother. I was like, let's just remove all of that. Let's just say, this is your budget. Treat it like a mini fund. You are going to invest it, and I'm going to evaluate you based on the quality of your investment decisions, which is not just markups. It's actually the quality of the people that you backed, the quality of their execution. It's actually way more qualitative than, and they're like, why don't you make it quantitative? I go, because then they'll figure out, they'll reverse engineer what gets fast markups.
Game design.
They will game the game.
They'll optimize towards whatever those metrics are.
So I told them, I was like, my goal is to show consistent, good decision making on founders. And I start them with 50K checks. And I go, listen, at 50K check, you're not sitting on the board. You're not the primary investor. You're not pricing rounds. You're basically an angel. And if you can't get 50K,
and you can probably, and if you can't get 50K and snuck in there, then there's a real problem on the winning front.
There's a real problem. And so I tell them, here's $500,000. Go make 10 investments. Here's the important thing. If you want my input or feedback before you make an investment, I will give it to you. You're just not required to present anything to me. You can come to me and be like, here's the safe. Here's the docs. I want to do this one. And as long as the company passes our due diligence process, background check, and all that stuff, you get to do it. And you get full attribution, full track record attribution. And David, I found in a year or a year and a half after giving people money, I kind of know two things. What do they think good looks like? And what are they able to get into? I know those two things. And then the question's like, okay, now that I know those two things, if I were to give this person more money, my assumption is they will continue to do the things that they think are good. And for me, the only question is, do I want more of that stuff in our firm? Are we aligned? And it's been a great program. I'm looking to scale this program. Right now, it's only available to people at the firm. We're running a little mini experiment to see how it works with people who are friends of the firm, but not fully employed here. And I've told my LPs, when I bring you the next generation of investors at Precursor, you will have quite a bit of data, not about how they invested money at some other firm, but how they invested money here with our strategy. And you'll be able to look and see, like, is this someone who you all want to trust with your money going forward? So it's super fun for me because I get to watch them in action.
I really like this, because at the stage you're investing, there's no right or wrong answer at the time. There's no amount of data. There's not enough data that exists to know quantitatively like what the right decision would be. And it also just focuses on measuring what actually matters, as opposed to what's your ability to convince, to sort of politic and convince people to, do stuff. I feel like it also rhymes a little bit with what little I know of. If I look in broader in finance, you look at these, pod shops or, hedge funds where, you have PMs who kind of do similar sorts of things. It seems a way to empower people and in a very direct way.
Ironically, like the three conversations I had that kind of helped me figure out this program, one was with a friend of mine who runs a hedge fund. And he's like, this is what we do. We just give people money and say, like, show us that you can do it. And we start them off with enough money that we can get an answer, but not so much that they can blow a hole in the firm. A second one was, I talked to a very frustrated associate who'd brought in a bunch of good deals, but really didn't know how to get the partnership excited about them and felt like they wanted to do them, but like they were blocked. And the third was, I talked to a bunch of people at my own firm who were like, when do we get the keys? I was like, well, the bigger the pool of capital I give you, the longer I have to wait because the more sure I have to be. How would you guys feel about starting smaller? They're like, yes. And I told our LPs, I'm like, this is the cleanest way I know to get data, which is actually to remove myself from the equation as a decider, picker, or even like I'm not teeing these deals up for them. I'm not like, oh, I got this like golden deal. No, I'm like, you got to go find the stuff you want. So I also learned like, how aggressive are they at sourcing? So all the things I want to know, I kind of get from this program. And also it means a lot of our conversations about companies are richer. They'll come and be like, hey, what do you think of this founder equity split? And it's not academic because I'm like, well, you're going to put money into this company. What do you think of this founder equity split? That's probably a more important question. But if you want to talk about my general views about founder, well, we can talk about it in the specific. Or they're like, hey, I got a reference on this person. Like, what do you think this means? And I found that like, if we made this fantasy venture capital, and it's like, I'm going to give you this synthetic portfolio, it wouldn't be as real.
No, it's like playing poker with, fake money, monopoly money.
Mm-hmm.
Okay, so we've talked a lot about your investment, your decision-making on the first check. So this seems like a good transition to talk about reserves and follow-on. because this is a real area where I'm still struggling to. Fund one is very simple. We don't really have reserves because the fund is so small. Fund two, it's definitely much more of a live concern. And I've heard you say elsewhere, there's only so much damage we can do with our reserves strategy, which I love. But then the other thing I also heard was, basically the idea is the reserves are really only for the top 20% of your portfolio. And naturally that leads me to the question, how do you figure out what the top 20% of your portfolio looks like?
This whole reserves conversation, though, I don't know, David, like, I was really fascinated when I went out. We've always been a 75-25% firm. Majority first check. So 75% of our dollars are first check, 25% are reserve. And I went to LPs and they're just like, you're not going to own enough of your winners. What about future dilution? I was like, guys, our first fund's a $15 million fund. That fund will live or die based on selection, probably not on fund management. Also, just, we do most of our pre-seed investing at mid-single digit post-money valuations. So I've told a bunch of our LPs, like, all of these follow-on dollars kind of compete with like writing a new check. By the time companies get to Series A, it might be $40-50 million valuation. And what do you really know, if we're honest? You know more than you did at zero, but the company's 10 times as expensive. Is
what
the
about
optimal?
seed?
Yeah, at seed versus like, I feel like at seed, when we started pre-seed, we'll definitely do. Most of our reserves are actually the seed rounds of companies where we led the pre-seed. Because usually at that point, I actually do know more. Ironically, I typically know more about the management team and their ability to execute than I do about the business. And so when we underwrite those follow-ons at seed, I'm like more confident that this management team is going to continue to solve the problems that will arrive in the future than I was at day zero. But like usually, like if we got in at mid-single digit post, the seed is at like mid-teens post. So we're paying a higher price, but it's like double or triple. It's not crazy. And we've actually learned quite a bit of, the most important thing we've learned is like what happens when you actually inject money into this company? Does it change its behavior at all? And like learning that the first time is really valuable. Also, whenever I listen to people talk about reserves, I'm like, okay, if you are a perfectly all-knowing individual who knew immediately which companies were the very best ones, and you had the ability and capacity to concentrate dollars into those companies early, then yes, you should have more in reserves. The number of conditional statements that were nested there should tell you how difficult it is. And like for example, in almost every fund we've done, we've had a hot company in the first year that looks like it's going to be a breakout winner that gets off to an incredibly fast start. With the benefit of hindsight, in no case in our fund has that company ever turned out to be one of the companies that matters. And in 2 of the 4 cases, those companies went to zero.
Wow. And in hindsight, you've described that what you're talking about as kind of early false signal. Any commonalities, any pattern recognition around what those signals were?
In each of those cases, the companies were growing really quickly, but there was something about them that made me nervous. It was either the CEO or the level of data or the description for why it was working so well, or they were working so much better than everybody else in their ecosystem. I was like, while I'm happy that we have this rocket ship, I don't love the narrative around this. It was just like kind of more like in the pit of my stomach, something always felt off. And the tricky thing was LPs would ask me like, wow, these companies are really doing well. And I'm like, oh, they've got up to a fast start or they got a fast markup. Like, for example, right now, we've had a couple of the AI companies that have gotten really quick markups. In some cases, I totally understand why based on the performance of those companies. In other cases, I'm just like, that CEO is a fantastic storyteller. And like, we now have a higher bar to clear in terms of what we have to grow into. And that's scary and hard. The trickier thing is we've had some companies, particularly in a world of like safes on top of safes on top of safes, where we've had companies that have done quite well. And my LPs have been like, why are you excited about this company? You've got 3 safes that cost. How good of a company can it be? I'm like, I need you to separate the carrying valuation from this company from my expectations about its future. And so now what I tell people is I really don't want to talk about what companies feel like the best ones in the first year. I can tell you that, but please don't pull it out of a drawer a year later and say, what happened to the companies that were on this list?
So much food for thought there. So one of the other things that's unusual about you in this day and age, perhaps, is you're a generalist. And in a time where it feels like many of the emerging managers are specialists of one sort or another. And I think your rationale for why to be a generalist, it really resonates, which is, one thing being different sectors can sort of fall in and out of favor. And if you're really dedicated to one, you have a lot less agency, or, the outcomes can be very binary, which is great. But the question that sort of leads to is, how do you think about circle of competence and what kinds of deals you're A, qualified to evaluate, and B, where you can also be helpful to the founder? And I will preface this by saying, I think one of the answers to this question is you have to be Charles Hudson. And I say that because having sat in another room where you were evaluating pitches, and I think the company pitching was doing factoring in South America, and you and I think Elizabeth Yin was the other person in the room, were just immediately had like 10 reasons why you had seen in businesses like this what the challenges were. And I was like, my God, this is so maybe the answer is you have to be you, and you're kind of you've been doing this so long, you're an encyclopedia of markets and business models, and so maybe that's the answer. But tell me, is there any other way, or what's the rationale for being the generalist?
A couple. One, I don't have any deep conviction about one category where I'd want to, unlike you, I don't have like the depth in one category to be like, I'm going to specialize in this.
Ironically, I have depth in gaming, but that gave me a reason to not actually want to focus on game.
I totally get it. First of all of the firms that I really admire are generalist firms. All of the big venture firms that I think have built our industry are generalist firms. And part of it is I feel like there will always be new sectors in tech that require you to quickly learn how they work and why they matter. And I think that's actually like a repeatable skill. Now, that being said, there are certain sectors where being a generalist is harder. Like when we first started doing digital health, I didn't know all of the acronyms and alphabet soup of payers and providers and all of this stuff. But I was like, as a pre-seed investor, I'm mostly picking people. And my view is like, my job is to pick the expert, not be the expert. So my job is to find the person who I think knows the most about this problem with the best proposed solution, who's going to figure out HIPAA compliance in AI. I don't need to know that. And the odds of me knowing it better than the founder are really limited. And so I've always felt like the ability to quickly learn something new is something I actually look for in the people that I hire at Precursor, because I think it's an essential skill. And the ability to quickly get your arms around the basics of a business, not all the specifics, but the basics of a business, and be able to quickly assess a person in 30 minutes is basically the job at Precursor. You're going to we did an electric boat company. One of my LPs was like, how'd you figure out about electric boats? I'm like, oh, I'd done an electric vertical takeoff and landing drone company. So I learned a little bit about electric drivetrains. So also you have to be a collector of facts. And so if you meet thousands of companies a year and you compound that over 10 years, eventually you're like, I have all these little bits and bobs that I know a little bit about a lot of different businesses. And you start to figure out like in factoring businesses, you're like, it's cost of capital and it's loss ratio. You start to figure out, well, these are the general threads you should tug on with these businesses. And it really helps. What I will say is there are times we lose deals to specialists because that specialist is someone who that founder says, this person has unique knowledge in fintech. The irony is in many cases, I'm like, we should go get one specialist and a bunch of generalists. You don't need 3 fintech VCs if you're building a fintech company. You probably don't need that. One really good one will give you the insights you need. And what I always tell our portfolio companies is they'd be surprised. A 0 to 1 company has much more in common with another company at its stage than it does with a more mature company in its category in terms of the problems and challenges.
Yeah.
And so I'm kind of like, at the end of the day, all of these companies have the same problem. Find product market fit, build an early stage team, prove out your business model. The mechanics of how you do that are different in each case, but the challenge is the same. And so what I tell our team is like, there are certain points, inflection points where specialty knowledge really helps. And being a specialist, I think, makes sourcing easier in some ways. But the thing I enjoy about being a generalist is also like, I'm not jaded about certain categories because I haven't seen 100 ways that a digital health company can fail. And so sometimes we're like naively optimistic about things. People who know more will tell me that won't work. I'm like, well, it hasn't worked. I agree with you on that. Has not yet worked and will not work are not actually the same thing.
Yeah, I think there's I suffer a little bit from curse of knowledge when it comes to gaming, where it's like, it's so hard to, we still have made some gaming investments, but I mean, we always make them sort of despite ourselves a little. Okay, we've talked a lot about buying. Let's talk about selling. Because it seems like there's also been a bit of a sea change in, we were a kind of a long only business for a very long time, basically. And you've talked now about being a default seller in certain later rounds, especially kind of post 2021. I would love to, but I think you've also said elsewhere that the folks who who do this best they have a well-established framework that's not sort of emotional. But so talk to me a little bit about what your framework looks like today and what other frameworks you've seen that you think are relevant to people who are investing at the stages that we do.
I just want to credit the folks at Freestyle and the folks at USV in particular for like giving me really good perspective on this issue. I think as in life with most things, if you make something a regular habit, it's easier to do and it's less impactful when you do it. So we have it's funny, I tell LPs all the time, not being a significant lead investor has a bunch of other like side benefits. One is that when we decide to sell secondary, it doesn't mean as much as it would if we were on the board and we owned 25% of the company. So that's, I think, important context. I have regrets. We should have done more selling in 2020 and 2021. The DPI picture, particularly for our first fund, would be even more favorable had we done more selling. And I didn't do more selling because I think as a VC, I'm always thinking about our performance on two dimensions. One dimension is honestly absolute. Regardless of what other people are doing, are we giving people a good return on their money? And second is relative, which is relative to our peers and benchmarks. How are we doing? And if I'm honest, I think in 2020 and 2021, I sort of missed out on some opportunities to deliver what would be good absolute performance in pursuit of what I thought would be excellent relative performance. And that was a poor decision that I wish I could take back.
Maybe gloss for my benefit for people listening, the difference between absolute and relative performance.
Yeah. So absolute performance, I would say, for when I got in this business, a lot of LPs are like, it's really hard to deliver 3X. A 3X fund is hard to get. If you do that, you've done a good job. In 2020, a lot of LPs told me, 5X is the new 3X. And I was like, wow, okay, well, now what would have been considered great absolute and relative performance is still great on an absolute basis, but relative to expectations, X didn't feel as special.
Absolute relative to, say, public market benchmarks, things of that nature.
Or even what other folks were promising and committing to LPs.
Right.
And so we could have locked in some great gains that as prices came back down, it turns out X was always the new 3X. The spaceman meme.
It was the 3X all along.
Yep. And we missed out on some chances to sell. And so I also started noticing we had a lot of portfolio company founders who were selling in the B. And so I said, all right. And of course, as you know, LPs have been very focused on distribution and money back 2022 to 2024 with good reasons. They haven't gotten enough back. I totally get it. That being said, there's nothing that says that in the future, in 2027, that the balance between future benefit TVPI and current distributions DPI will be where right now it feels like we are over-rotated on DPI. When the money starts to flow back, I think people will start focusing on TVPI again. So the challenge as a fund manager is like, I want to be responsive to my LPs' stated and real interest in DPI, but I do not want to sell so much of our best stuff that when the pendulum shifts back, because this is a
you get beaten up by your investors for the other.
For that. And even worse, once you sell your best stuff, you're probably not going to find somebody to replace it. Like our first fund is fully deployed. Whatever we sell now, like the probability that something else will bubble up from the bottom and replace that as a winner is very low. So at this point, performance of that fund is going to be a function of like the sell decisions that we make with a bunch of assets we bought 10 years ago. So I started saying like, well, what if we just became a default seller of around 20% in Series Bs, provided that the pricing would deliver a meaningful chunk of money back to the fund, and that our decision to sell would not be disruptive to the founder.
And does the founders own? I've heard what some firms have said, hey, if the founder's selling, we're selling. Does the founder behavior factor into that framework or no?
It does. It's an input. And I think it's a question of degree. If the founder's selling a little bit of money, selling a little bit of shares to like buy a house or pay for a wedding or, provide some financial security for their family, maybe it matters. Also depends on how long they've been at it. But I think it's an input. If the founder's just selling, it always means that like, well, we should at least consider why they're selling. And if the founder's just selling a lot, then I should probably ask like, well, why are they dumping all of this stock? And why are they being allowed to dump all of this stuff? Yeah. And so there have been a couple of cases where if I used our rubric today, we would be way better off. We would have sold even more than I would have been inclined to because of the decisions and behavior of the founders. And we didn't do that. And so I found it's also like just telling founders at the A that like, hey, by the way, we oftentimes like to sell at the B. So when you do the B, don't be surprised if we come and have a conversation. But it's not like we want to go force a sale. It's not like I'm going to go on some secondary market. And like we've said, we're only going to do this in conjunction and with the blessing of the founders. If we don't have those things, we're not going to do it.
It also makes a lot of sense in terms of, the other institutions stepping in that need their ownership, and there can be some benefits there too.
Truthfully, what I would really love to do, we haven't solved this yet. I would much prefer to allow our LPs who need liquidity to buy and sell their whole positions in the fund, because trying to make individual buy-sell decisions about companies is hard. And we have some LPs who are like, don't sell anything, like hold it to maturity. Like we're not subject to the same DPI pressure. And to your earlier comment, like LPs are not a monolith. We have some LPs who are like, I don't want you to sell anything. I want you to hold all of this. Only sell it because you think it's overpriced. Don't sell it to deliver interim liquidity to me. That's not something I'm concerned about. And others are just like, interim liquidity is great. It makes my life back at the ranch easier.
Yeah. So in some ways, it would be nice if that was a more granular way to handle all of this. Mm-hmm. Okay, penultimate topic. I'm not going to let you go without talking about AI, and specifically, I want to talk about your agita around AI investing, and I'll give you my 2 cents because I have similar agita. I think there's a lot of things going on. We've talked a little bit about just unbelievable amounts of capital being deployed at historic valuations in the foundation model companies, and I think one of the key things and what that means is firms like ours, we are generally, I was going to say relegated to, but that's probably not the right way to characterize it. But sort of means that really where we play mostly is the application layer. I don't understand the dev tools piece well enough at all to play there, right? Leave that to people who are more technical than me. So we're talking about the application layer. And I think the key question for companies who are building at the application layer is how secure is what you're building against the sort of constant erosion by the advancing capabilities of the foundation models. You've talked a bunch about companies that pitched you things that later became sort of core functionality. You mentioned folks who were like, we're going to voice enable ChatGPT. And, you're like, well, I'm pretty sure there's a good chance that they're pretty interested in doing that too. So let me sort of flip it around. What kind of companies have you felt good about backing at this layer?
It's funny that there's two other slides from our annual meeting that I debated turning into a blog post, but I haven't not yet done that. One was like, here's all the reasons why I'm cautious on AI. It's deflationary, moat, all the things you mentioned. The next slide is like, here's why I feel really exposed holding this point of view in this market. And I was like, all of the markups right now are in AI companies. All of the big mega funds with smart people are all in on this thesis. And here's like little old me, like saying the sky is falling. If we're wrong, it'll have repercussions, but that's like any consequential decision. The companies where we've been investing have mostly been companies, and this is probably the nuanced thing that I've found also, like if you're a fund manager and you go meet with LPs and tell them you're skeptical on AI, they look at you like, are you not doing your job? Every other person who's come in here is enthusiastic. And so what I've been telling people lately is I'm focused on companies where AI is up to the task today. And I think what I realized what was really happening was I was meeting companies who were telling me in our agentic future, and I'm like, but when is our agentic future? And this was in 2023. I'm like, is it 2024 or is it 2027? They're like, oh, it's definitely 2024. And I'm like, but if it isn't, you're like cooked. And so I kept meeting these companies who were like, well, when AI can do this, I'm like, I agree with you. Long term, we're totally aligned. AI will be able to accomplish that task. But the internet taught me one thing is that it takes a lot longer for most things to work the way you want them to than you think. Now, look, everyone's like, but AI is compounding faster than the internet. I agree with that. But the internet took 25 years to kind of get to the point where like it mostly does what I think it should do most times commercially. Still not perfect, but it pretty much maybe 15, 20 years. I'd say 25, whatever. Some arbitrarily long period of time, but it wasn't 2003, right? Right. And even if you're like AI is compounding faster, so cool, maybe it all works in 7 to 10 years instead of 20 to 25. If you start a company today, presuming that AI capabilities that you need to exist today and they don't, you might have made a mistake in starting that company. And so I look at a lot of these, and I use a lot of these tools, and I'm like, some of these tools are great. Some of these tools, I use them, and I'm like, I think you made up that answer. They're like, you're right, I did. And I'm like, ooh, I'm glad I didn't trust that with like a mission critical thing.
Yeah, I actually had, it's funny. I actually had the opposite thing happen. It's one of the, I use AI quite frequently. I was like, oh, I'm going to upload all of Charles's podcasts and, have it sort of help me, sort through topics and things. And it got convinced, and I managed to very easily convince. I was like, where did it, Charles said this thing? Just confirm. And it was like, oh no, I made that up. And then I was like, no, you didn't make it up. I've seen it. I've heard him say it. But like, yeah. It's like, oh yes, he said it in episode 7. I was like, no. And eventually, you end up sort of like, oh god, like I'm spending more time, like checking its work. So yeah, I think we've all had those experiences.
And so I keep coming back to this thing, which is like, we have some AI companies where I'm like, the thing you've bitten off is within the realm of what I think AI is capable of doing today. But it's also gives you a front row seat that as the capabilities get better, to use this as a leverage point to do more. And I think what it's meant is there are things that feel like they're 12 to 24 months too early. And I think a lot of those companies are not going to make it because they won't be able to stay in business long enough for the innovation that they need to happen. And I think framing it that way has made it easier for me to communicate with my team and also to communicate with founders. The other thing is, when you're an investor, I'm like, if I meet 10 companies doing something, there's probably 10x that.
Yeah.
And as a founder, you maybe know the 3 or 4 that you've heard of, but I'm like, no, I've had like, and there've been some categories I'm like, I just can't do it. And last, I've invested in an AI related sales company. And I was like, God, sales takes such a red ocean. What am I doing?
Yeah.
And I was like, I just really believe in these founders. I spent time with them and I think that they're really special people.
Same.
And so in some ways I told my team, we're kind of doing the same thing we've always done, which is we're trying to find really bright, exceptional people that we think will be very successful in building businesses. We just have to cut through some of the BS around AI and find people who have time frames and timelines for the technology that match our own. And I would also say, like, I've met people who've raised $20 million seed rounds for AI companies, and they're just like, we're well aware that the tech isn't up to the task today, but that's how we raised $20 million, so that like the window of time we have. But I also feel like when you foie gras companies like that, sometimes you lose the thing that makes small companies special, which is urgency and simplicity.
I think that's a great note to almost end on.
You did say penultimate.
I know. So I have a kind of a personal one, and we've actually you've answered one piece of it a little bit, but the thing I've admired about you is you are enormously productive, and we have some of the secrets now of how. And I think I've struggled with, as a founder for a long time before this, and I still consider myself a founder of sorts, although it's much easier experience in many ways founding a venture fund. And I've always struggled with balancing being a happy and well-balanced person with the ambition that I have. And you strike me as someone who's been quite good at that. So, and it's particularly top of mind for me since we recently had a baby, and, I'm very conscious of more than any time in my past that I have a lot of other obligations and things that I should and want to be doing. So how can I be a happier and more well-balanced person, Charles, and still ambitious to do the things I want to do?
I have good news and I have bad news for you. I'm going to give you the bad news first. I think the first 5 years of starting Precursor was the hardest I've ever worked, was the least balanced I was, and was like not long-term sustainable. And I say that because we didn't have any money. We had like 45 million under management, and basically all of the fees I had I kind of put them into like building a team that would, because of our volume, I was like, we need team people sooner. And I have to do more of this stuff myself until I can afford the people that can take this off of my plate. And I'm grateful for that time, because it's the classic, like, do all of the jobs at a startup and then you can figure out who to hire. And I'm glad that like I have 3 people in finance now, and I'm glad I have somebody in IR, and I'm glad but like, it was really hard. And I'd say I did the best I could those 5 years. But a long time ago, somebody gave me a piece of advice that I think about a lot. And he's like, look, in life, you can do 3 things well. And this is around the time my son was born. He's like, you're a husband, you're a father, you run your firm, you have friends, and you probably have like stuff you like to do outside of work, which we'll generally call interests and hobbies. He's like, you can probably do 3 of those things well. He's like, you can pick the 3 that matter to you. He's like, I would strongly encourage you to pick husband and father as 2 of them. And he's like, the 3rd one is up to you. But he's like, I think it's going to be work. I was like, okay. He's like, so that means like you probably will be disappointed with your performance as a friend at times. And you will have a harder time with like hobbies and interests unless they're somehow integrated into one of those other things. So like, look, if your hobby is like coaching kids soccer, you can actually make that work. And it's been an interesting lens, David, because I have other friends who've made different choices. I have some friends who've chosen like work, fatherhood, and golf. They're like not that into being a husband, and like they're kind of like, but they like being a dad, and like they've chosen like a different combo. And husband, I'll just say like partner. It doesn't have to be like a marriage situation. This person gave me this advice before this conversation was more evolved. But it's given me a way to think about the choices that other people have made too. Because I don't think he wasn't telling me that you specifically can only do 3 of these things well. He's like, most people can manage to do 3 of these things well. And what I realized was like, I have to choose what 3 things I want to do. And I have to also understand that in choosing those 3 to do them well, it probably means other things won't go as well. And it was really like clarifying for me to be like intentional about choosing the 3 that I chose. And in most weeks, like being a dad, being a husband, and running Precursor consumes like the majority of my time. I get to ride Peloton at night. I get to run a little bit on the weekends, but I don't have any like regular hobbies or interests. I don't. but I guess I'm really happy with my choices. And I'd like to think if one day I woke up and I was unhappy with my choices, I could choose a different combination. Probably be hard at this point in life, but like I'd like to think that at some point I could choose that like I don't want to work as hard. I don't want work to be the big three. I want to like really get good at golf. Or I really want to do something else. I want to travel. Like I want to prioritize taking care of a sick parent or relative. It just forces me to think like, what are you going to give up if you make something else a priority? And it's really been helpful to me as like a forcing function.
That I think is a fantastic place to end. Charles Hudson, thank you very much.
Thanks for having me. This is awesome.